Most investors don't miss the next big winner because they lack intelligence. They miss it because they arrive after certainty. By the time a stock dominates headlines, ETF inflows, and social media feeds, the asymmetric part of the opportunity is already gone. Nvidia didn't create generational wealth in 2024. Palantir didn't do it last year either. The real gains were made years earlier, when conviction felt uncomfortable and the story was still forming. Here's the structural problem heading into 2026. Capital has never been more crowded. Today, the top 10 stocks make up more than 35% of the S&P 500, driven by passive flows, ETFs, and algorithms that relentlessly funnel money into the same names. These companies are excellent businesses, but when everyone owns the same trade, future returns compress. At the same time, the AI conversation is evolving. AI is no longer theoretical. It's physical, it's infrastructure. And the true bottlenecks are no longer just chips or software, but power, cooling, networking, and compute availability. Global AI-related infrastructure spending is projected to exceed $1 trillion by the end of the decade. Yet that value won't be distributed evenly. It will concentrate in very specific layers of the stack. This is not a hunt for hype or penny stocks. These are established businesses with real customers, real revenues, and expanding margins. Companies that haven't had their explosive moment yet, but are positioned exactly where the next phase of growth is forming. First on the list, Vertiv Holdings, ticker symbol VRT, a company most investors rarely talk about, yet one that quietly sits at the foundation of the AI economy. While markets obsess over GPUs and AI models, Vertiv operates in the layer that actually allows those models to function at scale: power delivery, cooling, and physical data center infrastructure. Vertiv's business model is built around mission-critical systems that data centers simply cannot operate without. It supplies power management, UPS systems, rack infrastructure, and increasingly, liquid and hybrid cooling solutions. As AI workloads push rack densities higher, heat and electricity have become the real gating factors. Air cooling alone is no longer sufficient. Liquid cooling is moving from optional to mandatory, and Vertiv is one of the global leaders in that transition. What makes Vertiv especially compelling is that it isn't just a hardware vendor. Once its equipment is installed, the company layers in software, monitoring, and long-term services, creating recurring revenue and operating leverage. That's why margins continue to expand as revenue grows. The financial momentum is difficult to ignore. In its most recent quarter, Vertiv delivered nearly 30% year-over-year revenue growth, operating profit growth close to 40%, and free cash flow growth at a similar pace. Organic orders surged roughly 60%, pushing backlog to around $9.5 billion. Management raised guidance, expanded operating margins above 20%, and continues to strengthen the balance sheet while buying back shares. The broader environment remains highly supportive. Hyperscalers like Microsoft, Amazon, Google, and Oracle are sitting on hundreds of billions of dollars in cloud backlog. Every dollar of that backlog eventually translates into more data centers, more power infrastructure, and more cooling systems. Analysts expect Vertiv's earnings to grow more than 50% over the next 2 years. Yet the stock still trades at a forward valuation below several industrial peers with slower growth. There are risks. Hyperscaler spending can be lumpy, and competition is real. But as long as AI compute continues to scale, power and cooling remain non-negotiable. Vertiv isn't writing a narrative, it's monetizing a physical necessity, and that makes it one of the most direct ways to participate in the next leg of AI infrastructure growth. Now let's shift from power and cooling to the next critical bottleneck. Because after electricity and heat, AI runs into a very different constraint. Second on the list is Arista Networks, ticker symbol ANET, the company solving how fast data can actually move between GPUs. AI performance today isn't limited by compute alone, it's limited by synchronization. If GPUs can't communicate fast enough, expensive compute sits idle. That problem intensifies as clusters grow larger, and it's exactly where Arista dominates. Arista designs high-performance Ethernet switching and routing hardware, paired with its EOS operating system and CloudVision software platform. Its networking gear is used in the most demanding cloud and AI data center environments in the world. As AI models scale, networking stops being a background function and becomes mission-critical infrastructure. Recent results confirm that Arista is executing at an elite level. Revenue grew nearly 28% year-over-year to about $2.3 billion, beating expectations, while gross margins stayed above 64% and operating margins hovered near 49%. That combination of growth and profitability is rare in hardware. Cash generation remains strong, giving the company flexibility to invest aggressively without financial strain. What truly sets the stage for 2026 is Arista's technology roadmap. The rollout of its 800 gigabit Ethernet R4 platforms and Hyperport technology directly targets AI networking bottlenecks. These systems are designed to move massive volumes of data with lower latency, less congestion, and better power efficiency. Management has indicated that these innovations could reduce AI job completion times by over 40%, which translates directly into lower compute costs and faster model iteration for customers. The opportunity remains enormous. Arista has expanded its estimated total addressable market to more than $100 billion by the end of the decade, while its current revenue run rate represents less than 10% penetration. AI-driven data center networking is expected to grow at a rapid pace for years, and Arista has already surpassed legacy competitors to become the market leader. Yes, the stock trades at a premium valuation. Expectations are high, but businesses with sustained growth, best-in-class margins, and deep competitive moats often look expensive right before they grow into those multiples. If AI infrastructure continues to scale, Arista is positioned as one of the clearest beneficiaries heading into 2026. And now we move to the most misunderstood name on this list. Third is Nebius Group, ticker symbol NBIS, a stock the market still struggles to categorize correctly. Nebius is not simply another AI cloud story. It is an AI-native compute platform built specifically for training and inference on large NVIDIA GPU clusters. Its core value proposition is speed and availability, in a world where demand for AI compute is growing faster than hyperscalers can deploy capacity. The validation is already there. Nebius secured a $17 billion multi-year deal with Microsoft through 2031, along with a $2.9 billion agreement with Meta for dedicated GPU clusters. These are not experimental pilots. They are long-term commitments that anchor utilization and credibility. What the market is still missing is where future growth is coming from. Management has been explicit that enterprise and AI startup demand may ultimately represent the majority of long-term opportunity. In Q3, Nebius generated over $130 million in core revenue, driven largely by enterprise customers, and revenue estimates for 2026 have been revised sharply higher. Meanwhile, institutional ownership jumped more than 40% sequentially, even as the stock consolidated far below its October highs. A major catalyst arrives in the back half of 2026. Nebius will be among the first NVIDIA partners to deploy the Vera Rubin platform. NVIDIA has indicated that inference costs on Vera Rubin could be up to 10 times lower than prior generations. As AI workloads shift from training toward inference, that cost advantage becomes decisive, and Nebius will be offering it early. The risks are real and should not be ignored. This is an extremely capital-intensive business. Nebius plans to scale from roughly 220 megawatts of connected power at the end of 2025 to as much as 1 gigawatt by the end of 2026. Any delays could pressure the stock, and dilution is likely as expansion is financed, but that's the trade-off. Nebius is attempting to monetize AI compute scarcity before it becomes commoditized. If management executes on capacity, utilization, and customer growth, the company evolves from a speculative narrative into a strategic AI infrastructure platform, one the market may still be underestimating today. These are not the most obvious stocks in the room. They're not the loudest, and they're not driven by hype, but they all share one thing in common. They sit at critical choke points of the AI economy: power, networking, and compute availability. 2026 won't reward investors who chase what already worked. It will reward those who understand where the next bottlenecks are forming and position early before certainty arrives. As always, this isn't about guarantees. It's about probabilities, patience, and discipline. The goal isn't to predict the future perfectly, it's to be aligned with it before the crowd catches on. I'll see you in the next one.